The taco trade drove down the dollar. But with the trade war starting to go Trump's way, the short dollar thesis is looking shakier. What does winning the trade war actually mean for the US economy and the US dollar? What should you be doing with your money right now? A current account deficit country has more leverage than a current account surplus country in a trade war. This is because reduced international trade will result in a greater decline of the imports of the deficit country than its exports. All else being equal, this means a trade war represents a positive contribution to the GDP growth for the current account deficit country, as opposed to a negative contribution to the GDP growth for the current account surplus country. This is why in a trade war, the currency of the current account deficit country ought to appreciate against that of the current account surplus country. So why is the US dollar lower now than on April 2nd, when Trump shocked the world with his reciprocal tariffs? There are two reasons for this. One, the market came to believe after April 9th that Trump did not have the stomach to see through his trade war. Two, increased US policy uncertainty reduced foreign demand for holding US assets. In other words, short-term capital flow dynamics overwhelm any long-term effects of potential current account improvement and GDP support from decline in imports. Year to date, the US dollar is down against all major currencies, including the RMB. The dollar's decline has been so great that it's been a key driver behind the outperformance of US tech stocks and EM local currency debt, the two biggest beneficiaries of the taco trade. But do these winning trades of the second quarter have legs? What does Trump's trade deal with Japan tell us? There have always been three potential outcomes in Trump's tariff war. One, Trump backs down. Two, Trump does not back down and other countries retaliate. Three, Trump does not back down and other countries do not retaliate. The first scenario is arguably the worst for the US dollar. The second scenario should be positive for the dollar. The third scenario should be very positive for the dollar. A week ago, if you had asked me, I would have said that scenario 2 was the most likely heading into August 1st. This is why I was long gold and short US consumer discretionary stocks. Sure, the deals that Trump managed to get out of Vietnam and Indonesia fell into scenario 3. However, I didn't think these deals told us much about how would go the negotiations with the larger countries like Japan, India, and the European Union. The fact that the US-Japan deal announced this week follows the same pattern shows I was wrong. Less than 2 months ago, Prime Minister Shigeru Ishiba had promised Japanese voters that he would not settle for anything less than zero tariff. This week, he accepted a 15% US tariff and agreed to an investment of $550 billion in the US, not only to be directed by the US government, but 90% of the profit will go to the US government. It is hard to see the deal as anything other than a complete capitulation by Japan. If the US gets 90% of the profit, it means Japan has only the downside if the investments go bad. Can Japan even count on getting its principal back? I can't help but to wonder. My simple back-of-the-envelope calculation shows that the implicit cost of Japan from its investment commitment under the deal would be equivalent to at least an additional 10% tariff a year. What this means is that what Ishiba agreed to is a 25% tax for the privilege of continual access to the US market. This was a major victory for Trump. There's nothing beating around the bush about it. What's more, prevailing over Japan will also make it easier for the US to push around the others. Japan's submission has increased the pressure on the likes of South Korea and Taiwan to follow suit. Reports this week suggest that Seoul is now engaging with the US about a similar investment commitment plus a 15% tariff. As I argue over the past month, if there was any chance at all that Trump was going to back down in his trade wars, the rest of the world had to join forces and coordinate their responses. And for that to happen, Japan, the second largest economy in Asia, had to hold the line. America, as the world's hegemon, is adept at divide and rule. Trump's trade war is just another illustration of this. The market's short dollar position was a bet on Trump's strategic overreach and a bet on a transition to a multipolar world. The bet looks much less compelling this week. What about the European Union? Reports this week suggest that the EU is prepared to accept a 15% US tariff. If you had told me a month ago that Europe was going to agree to spend 5% of its GDP on defense and pay 15% tariff on exports to the US, I would have said you were crazy. But this seems to be exactly where we're heading. Is this because of Trump's apparent change of heart about Putin? It's possible. Do I believe Trump will carry out his threat to hit Russia with punishing sanctions if the war does not stop in 50 days? I don't think so, only because it would send oil prices skyrocketing. But it is possible that Europe has decided to give Trump the benefit of doubt. Or European leaders might have decided that they cannot fight both the US and Russia at the same time. They might have decided that the Ukraine war takes priority with the intensifying Russian offensive. What all this means is that other than with China, it looks like Trump's trade war is going his way right now. What does this mean for the dollar in the markets? If winning the trade war is good for the dollar, what does winning the trade war actually mean? There are only two things we can say definitively about the economic impact of the trade war so far. One, US tariff revenue is rising rapidly. It looks like it might reach $30 billion in July. Two, US import prices have remained broadly stable, notwithstanding the tariffs. What this means is that the cost of the tariff is being borne by Americans as opposed to by foreigners. Thus, it is not wrong to think of the tariff as an income transfer from American companies and American consumers to the US government. But it does not end there. Trump is returning the money to American companies, American consumers through his big, beautiful bill with his many tax cuts. For this reason, net-net, we can think of the tariff as income neutral. The only real change brought about by the tariffs is the relative price between imports and domestically produced goods and services. Imports have gotten more expensive relative to domestically produced goods and services. In theory, given there's little spare capacity in the US economy at present, and given it will take time for companies to build up new capacity, prices should go up. Winning the trade war means higher growth, but it also means higher inflation. It is much too early to know, but how high will inflation go depends on the degree of substitutability between US-produced goods and services and imports. Whatever it may be in the long term, we're likely to see in the short term a further widening of interest rate differential between the US and the rest of the world. This should be supported for the dollar. The fact that Trump appears to be resigned that firing Jerome Powell is too difficult should also help the dollar's case. US tech stocks have been benefiting from the weak dollar and the uncertainty around the trade war. The weak dollar because a significant share of the revenue of US technology companies comes from overseas. The uncertainty around the trade war because the AI story is thought to insulate tech spending from the tariff threats. In this sense, trade deals boosting the dollar and easing concerns about tariff threats are not good news for the overvalued US tech stocks, at least in the short term. Thank you for listening.